So we've talked about the sectors within the markets, and a lot of times when we talk about sectors, we're talking about large companies. How does a loosening of monetary policy or the prospect that the Fed is going to cut rates impact smaller companies? So when we think of not the big names that we're always hearing about on the news, but some of the smaller capitalization companies, what's the impact on those?
Well, I would start this by saying we don't like to be overly tactical at Blue Chip. We pride ourselves on being long-term investors. And as a part of that, we're trying not to make knee-jerk reactions or short-term decisions. Yeah. Now, what I would say is that at the asset class level, there are certain times when certain asset classes should outperform. And there are also certain times, certain environments where specific asset classes should not be expected to outperform. Take, small caps in a high or rising interest rate environment. Smaller businesses are just more prone to declining profitability due to higher interest expenses in a high and rising interest rate environment.
It's harder for them to borrow money. They're spending a lot more to borrow. When they borrow, it's costing them more, so their profitability is down.
Right. So you just see interest expense representing a much larger component for small businesses relative to large businesses. Yep. The script is somewhat flipped as you enter this lower interest rate regime. And you can see how in this type of environment, small caps might start to become a little bit more attractive. The other thing I would tie into this is I mentioned before that the Federal Reserve is generally going to be late. So that means constraining the economy too, far down the road after the economy's boomed and kind of stimulating the economy too late into the kind of softening phase. Yep. And as you think about that, we have seen some economic softening, and I'm not going to say the Fed is overly late this time, but the fact of the matter is, as rates start to get cut and tamped down, it may not be that long before the economy bottoms out and actually starts to show signs of improvement. So that's another very conducive environment for small caps. If you have lower interest burden and an improving economic environment, that's a very strong argument for small caps. And actually, if you look back through rate cutting cycles going back from 2000 until today, small caps have meaningfully outperformed large caps, at least on average. And I think, again, we don't want to be overly tactical, but the whole point of saying all this is that you don't need to structurally own an asset class that you expect to underperform, or an asset class that has historically underperformed in similar economic environments in the past. I'm fine starting to think about small caps right now because I'm expecting, again, as the economy bottoms and kind of runs forward and interest burden starts to decline, small caps historically have shown some fairly attractive outperformance relative to large caps to the tune of 12% excess return for the year and a half following the first rate cut on average since 2000.
Yeah, what I love is that our investment committee is open-minded to other opportunities or possibilities within the market.
Yeah, and again, it's one of those things where you just have to stay in tune with it, right? Because even though on average, we've seen small caps on an equal weighted basis outperform large caps on an equal weighted basis for the year and a half following the first rate cut on average, that doesn't mean this cycle will play out exactly as we've seen the average over the last 25 years be. So you just need to stay on top of things. And I still would emphasize, even in small caps, a more quality-centric allocation instead of getting a type of portfolio that ends up whipsawing you around.
Yep. Sounds great.